welcome back. This is the second in a series of 3 on the track record of the Infrastructure and Development Bond Fund and its 30-year track record. My name is Voyono Ganchi, and I am the CEO of Futuregrowth. I'm again joined by my 2 portfolio managers, Jason Lightfoot, Senior Portfolio Manager, and Daphne Botha, Portfolio Manager and Risk Management at Futuregrowth. Welcome again, team.
Thank you.
So in the first segments, we covered quite a bit around the origin of the fund, the founding idea behind the fund, and now we get to actually how it works. The fund itself holds up to 55% in unlisted credits. This is instruments that do not trade on a screen. It has invested in toll roads, renewable energy, housing, and water, with some deals running 16 to 18 odd years. That kind of investing requires a credit process and risk discipline that most bond funds do not need. Jason and Daphne are going to walk us through what it looks like deal by deal. So I'll start with Daphne. Andrew Cantor was the previous Chief Investment Officer, and he used to say the best you can do as a bond investor is to get your money back. That sets a specific tone for how you think about credit. So working on 55% that can sit in private debt, deals that do not trade on an exchange, I come to you, Daphne, with the question. When a new deal comes across the desk, what does assessment actually look like? What makes a deal get turned away?
We talked about commercial returns in the first segment. So bankability of the deals are quite important. If the deal is not going to give us the commercial returns we're looking for, so we stack risk versus reward, and if those don't match, we turn the deal away. A key additional factor we look at is, who's the borrower? Who are we partnering with in this transaction? Is it people we've dealt with before? Do we have a good working relationship with them? Do they have skin in the game? Meaning, did they actually put some of their own money on the table to make this deal work? And so normally when we look at a deal, when it comes in, the first phase of the deal process is called the pre-screen. So we do a high-level look at the transaction, and we decide based on those factors whether we proceed with proper analysis, proper kicking off the tires, site visits, etc. It's a quick yes or no discussion. The whole team is involved, and just so that we don't spend unnecessary time working on deals that we don't think are going to pan out in terms of commercial returns.
Okay, super. And Jason, over this time, so I know it's been quite a bit of time since the firm was started, the fund started. Are there any rules of thumb that you've seen evolve through time as we've come through the years?
Yeah, I think we all know that the financial world is poor at reflecting on past mistakes. We make the same mistakes over and over again. So it's the idea behind the rules of thumb is it's a living document that kind of captures all the learnings that we've had over the last 25 years. So it applies to new analysts. So new analysts can look at the document and get a sense of, okay, if I'm doing that particular loan to that particular borrower, what do I need to look out for, and how do I need to structure that deal that then makes financial sense?
And maybe moving on to a topic that's been quite important for South Africa as a perspective, South Africa's electricity crisis. And this forced the government to open the door to private power generation through a program that they called the REAP program. I prefer to call it REAP than the actual name, the Renewable Energy Independent Power Producer Procurement Program. Quite a mouthful. That started around 2011, and Futuregrowth was one of the first institutional investors in. The return premium on those early deals, so what the market calls the spread, was around 4.5% above what would be risk-free, whether a government bond or a bank deposit.
Yeah.
Today, the same kind of deal pays roughly 1.8% above that risk-free rate. So Jason, take us through that renewables journey. What made those early rounds so attractive, and what has changed as the market has matured?
Yeah, as you mentioned, we were definitely one of the earlier institutional investors in that space. And prior to deploying the initial capital into those deals, we did a lot of initial work, understanding the regulatory framework, the underlying legal agreements, how they all tie into one another, talking to specifically with technical experts, understanding the technologies, before we were able to then initially deploy the capital. It was very much a team-based approach. We all got our hands dirty. I still remember back then I was part of the credit team, and we broke the documents down into individual pieces and then presented that back to our credit committee in terms of how they all fit into one another. As you mentioned, the earlier rounds were very lucrative, earning above J plus 400 for those deals, with a government backstop, because ultimately National Treasury stood behind those cash flows. Right now, there's been a change in the environment where the deals are pricing, as you mentioned, subpar 180. But again, in much more borrower-friendly terms as well, which doesn't really make sense for us to invest into those opportunities right now.
I think it's largely behind us, Daphne.
Renewables, no. The REAP, maybe yes. So I think it's important to note that the opportunity set for renewable energy is more than just REAP. You've got lots of private companies entering the space. I mean, one big area is rooftop solar. I mean, I assume a lot of our investor base, even our South base, have invested in, solar panels on top of your roof. I think that's a big sort of investment area, especially in an environment where Eskom, while it's improving, is still not, that stable. And also if their tariffs are increasing at astronomical rates. So if you can protect yourself as an investor right now, that's a good area to go in. And so for us, it's a investment opportunity, funding some of the businesses in that area. That's only one example. There are a few others. The way we look at it is the entire sort of value stream. It's not just who produces the power, it's those who produces the components that produces the power. So the factories producing panels. It'd be great if we can produce those panels in South Africa rather than import them. So those types of opportunities might still come.
Well, for us, we're largely focused on ensuring your panels don't get stolen.
Perhaps that Daphne's, I'm maybe a little bit more optimistic in terms of the future. If you look at RRP 2025, there's a much higher allocation towards solar-powered and wind-powered opportunities, meaning that in my view, even though we have this whole massive demand supply imbalance right now, there might be some sort of normalization that might come through, not maybe to the extent that we saw in prior years at those sort of levels, but maybe much higher than where we are currently.
I like it when a discussion gets meaty. Daphne, let's jump on to you leading here in the next piece, and then Jason, I'd also like to get your view here. So when you are lending money in the unlisted space, you can't sell the position if something goes wrong. You're pretty much locked in there. And that makes the relationship with the borrower and the legal protections in the loan agreement that we call covenants, or the rule book written in every deal, a permanent feature of the investment. So Daphne, what does active ownership look like when you're a lender, not a shareholder? And when a borrower is not meeting the terms in terms of the agreement, what levers do you actually have?
So I want to take you back to your quote from Andrew Cantor, the best we can do is get our money back. And so for me, that starts with the legal agreement. You have to make sure that the legals that you enter into with the borrower actually contains the protections that you want. You have to plan for the worst. That's the mindset of a borrower. You've got to protect the downside. We've got a whole list of pages of covenants that our analysts can choose from to add into the legal agreements. So the more of those you can put into the legal agreements, the better. Just think of us as the bank. You're coming to the bank for a mortgage bond. As the bank, we can, if you default on your loan, we can take your house. So we do the same in our legal agreements. We take security where we can. Ideally, physical, tangible buildings, brick and mortar is always a good level of security. But there are other forms of security that we can use. There are other covenants, so there are early warning signals, and so those could be in the form of financial ratios, and those the analysts track during the life cycle of the transaction. You can't wait until the deal ends and then look at that. So some of them are monthly reporting, some's quarterly reporting, and your first warning sign is if a borrower don't send the reports they're supposed to send. That's already a flag. It might not be a red flag yet. There might just be a turnover issue, or someone might have forgotten to do something. But as the analyst, you have to go to the borrower. What's going on? We're expecting this. You haven't sent it. So we have a lot of rights as lenders. And I think sometimes lenders forget what those rights are. We don't. We make sure we enforce those rights and that we get all our borrower counterparties to conform to those requirements.
Jason, does that match your experience? I've heard there's a good story about an airline deal.
Yeah, I mean, pretty much in the unlisted space, you do definitely have better line of sight, much better protections that you can put in place when you need to act. Coming back to the airline story, it was a deal that I was involved back in 2012 where we funded the acquisition of 7 Q4 Bombardier prop jet planes. And the premise was that we would lease them to a state-owned enterprise airline on a 10-year lease framework, relying on those cash flows. Things were fine for the first initial years, but in saying so, we did build in some tough conditions into those legal agreements where they were breaching one of those covenants at the time, which then afforded us to negotiate a partial government guarantee for that deal. Move forward into COVID. COVID was obviously a horrible point in time. Prior to that, this airline went into liquidation. We took our planes back. But again, no one was buying planes during the COVID years. So 2 years post that, we were finally able to find a buyer for the planes. And despite the fact that we weren't earning cash flows for a good two-year period, we still earned a return in excess of JIBAR over that period of time.
Sounds good. So lawyer, analyst, debt collector.
Yes.
Quite a lot of hats you have to wear in the fixed income space. Definitely just thinking about the interest rate cycles. They essentially the backdrop to everything in a bond fund. Duration, which is a measure of how sensitive the fund is to rate movements, is one of the main tools for positioning. This fund has a mandate to move duration by up to 1 year either side of what the benchmark would be. That's a relatively tight range, especially for a fund with this much illiquid credit. How does the investment committee set the guardrails around duration positioning in a fund where you cannot easily buy and sell a large portion of the book?
So if I think about all the funds at Futuregrowth, we have a set of investment guidelines for each portfolio that we manage. And so within that investment guidelines, there's certain risk limits that we set. So we'll set limits around interest rates, as you've mentioned. There'll be limits around credit exposure, liquidity, derivatives. And so when we look at those limits, they all need to match. So for instance, the Infrastructure Development Bond Fund is allowed 55% unlisted debt. I cannot now add a limit that says a minimum of 50% to government bonds, because that means I will never get to 55% unlisted debt. So these rules all need to work together. So in the Infrastructure Bond Fund, what we've done, we've got the 55% unlisted limit, then we have a limit of 20% to liquid assets. And that liquid assets is either the whole 20% in all constituent benchmark bonds, or a minimum of 10% all be bonds, and the rest are money market assets, so assets under 12 months to maturity. In addition, this fund's allowed derivative limits, so that derivative limits tie into the liquidity limits, because if you have derivatives, you need to have liquidity to make margin calls. It's also a pooled fund, so those liquidity limits are there to make sure we can buy and sell bonds to create liquidity if a client needs to exit an investment, but also to buy and sell bonds if new money flows into the portfolio. So they're not, when you look at those set of investment guidelines, they need to work together in a pattern. And so your rule set will be very different from a money market fund versus a bond fund versus an income fund.
So in segment one, actually, you spoke a little bit to the matter of liquidity and COVID. And Jason, has there been a part or time where you found yourself constrained due to the liquid portion when rates were moving quite fast?
Look, I mean, from a portfolio design point of view, I think we're quite deliberate in terms of ensuring that there is a set limit in terms of how much we can have in unlisted assets, which themselves are fairly illiquid. But again, it's a misnomer in the market that listed credit is liquid, because try to sell a large tranche of a liquid or a deemed liquid listed credit portion, and you're not going to be able to sell that portion. So we need to then manage liquidity in the sense that we stick well above that internal limits of, or the mandated limits of 10% in terms of the constituents of the benchmark, and then 10% in terms of money market assets, therefore to ensure that we have enough liquidity in the fund to meet those margin calls, which we did do so through COVID.
Cool. And not staying too much just on the technical investment terms, moving on to the, I guess, the impact side of things. You know, the fund itself doesn't only invest in headline transactions. Meaningful part of the portfolio has gone into projects that serve communities, such as housing, schools, health facilities, etc. And when you look at the portfolio today, where do you see the strongest overlap between developmental impact and investment return? Where do these two things genuinely reinforce each other?
I think for us, it's always been a thesis of commercial returns always come first. There's no substitution for that. So if a transaction happens to be developmental and offers you the right level of commercial returns, it then makes sense to allow that fund, or this particular fund, to invest into that opportunity. For example, if you look at affordable housing solutions, we provided funding to a very prominent player in the market that does office to residential conversions. On the face of it, a great transaction from a developmental point of view, because you're providing access to affordable rental stock close to places of work, transport nodes, but also in saying so, we were able to construct the deal in such a way that it offered us the right level of commercial returns from a risk-adjusted return perspective.
And from your side, Daphne, when you think about this developmental impact piece, how do you make sure that it doesn't become a reason to lower the bar on credit quality?
That's a really interesting question, Rio. So I think we've reiterated it, that commercial returns comes first. Subsidized developmental investing is actually the space of government, or sort of developmental finance institutions. We cannot use pension fund money to provide subpar developmental loans. It's just not done. So we draw a hard line. If we cannot find those deals that offer us the commercial returns we seek, we will disinvest. We will sit in government bonds. We tell our clients that when we sell the product, we say, if there's no deals, you'll be sitting in government bonds. It's a bond fund. You will still have bond fund returns. You might just not get the same level of developmental impact, but we're not going to compromise on commercial returns.
Okay, sounds good. And Jason, you've argued publicly that the constraint in infrastructure investment in South Africa is not a lack of capital. Retirement funds hold over 5 trillion in capital. The constraint is a shortage of bankable projects, meaning deals that are structured with enough regulatory certainty, risk sharing and legal architecture to attract money managed on behalf of pensioners. So if you've applied these 9 bankability requirements to infrastructure deals for 3 decades, give us the short version. What makes a bankable deal, and why is it so hard to get it right in South Africa?
Yeah, sure. So obviously we start off with cash flows. You need enough cash flow to service your debt. But alongside that, that on its own isn't good enough. You need certain aspects of regulatory certainty, alignment of interests, aligning back to our previous discussion around enough skin in the game, sound and very robust legal agreements to ensure that, if there are problems, that you are able to then work through and protect your interests. And then obviously sound governance. Governance, as I mentioned earlier, has a flow through to various aspects. It will factor in, it will impact procurement, it will impact your balance sheet and your income statement going forward. And ultimately, it will then impact you as a lender.
So coming to a close, I think we've covered quite a lot of ground in this segment: the credit process, the renewable story, active ownership, rate cycles, bankability. I think the thread through all of this is the discipline that we've had to apply over decades. So Daphne, if you had to sum up the infrastructure investing playbook in 2 or 3 lessons from the last 30 years, what would they be?
Okay, so for me, the first one is having the right partners. So our borrowers are partners with us. We've talked about skin in the game because we cannot invest in someone's business if they're not prepared to invest in themselves. It just does not work like that. Commercial returns, we said there is just no compromise on that. And the last one, so the thing with infrastructure debt in particular is debt matures. So one key thing that we need to manage actively on our side is our deal pipeline, making sure that we have sufficient deal flow, bankable deal flow, to meet our long-term returns in the portfolio.
So what comes through in this conversation is that through the 30-year track record, discipline has been most important. And that's where the returns that matter come from. In the final segment, we look ahead. Where does infrastructure capital go next? What policy shifts matter? And who is going to carry this going forward? Thank you, Jason and Daphne. And if you have not listened to segment 1, go back and start there. Follow, subscribe, and catch the next segment or the final part. We'll see you next time.